Private credit is, I would say, finally becoming a hot topic. It's really become one of the alternatives to funding. If you take a step back, I like to keep things simple. I'm an operator, not an investor. There's really two types of capital. There's equity and then there's debt, right? And there's a hybrid, there's somewhere in between. So really, being a private credit firm, private debt firm, we provide growth capital, non-controlling growth capital to non-sponsored businesses, and we help them grow, right? And essentially the capital is meant to be catalytic. It's not meant to keep the lights on. That's what makes it so impactful, and that's actually what I would consider good debt versus bad debt, because there is such a thing. And from our perspective, really what differentiates us, I would say, or just this asset class or instrument, is a few things. So one, it's non-controlling. Anytime, obviously, you take over equity-based financing or funding, you are giving up ownership of your company. Two, very creative in how we can structure. So from a private credit perspective, as a firm, we can actually tailor the credit solution or capital solution to exactly what you need to grow the business. Many different examples of that, but we can be very creative not only in how we structure, but also in how we collateralize or leverage assets to help maximize how much capital you have access to, right? So our average check size, anywhere from 10 to 50 million. We can scale up to 100 million plus, which is, I would say, usually much greater than traditional banks. And for folks who have exited or who have raised capital before, there's sometimes an unknown, but debt is always cheaper than equity. Sometimes folks think it's actually the opposite. But the caveat there is as long as you believe in your growth story and you're actually going to go ahead and execute on it, right? If you're betting someone else's money, that's different, but you're also essentially giving away your ownership.
So let's say he is building AI data centers for people. He needs growth capital. You are not taking an equity stake.
Correct.
So how does he give you collateral, or are you taking a risk on him?
So good question. So from our perspective, it's a bit of both. What makes us different and what makes private credit firms different is we can leverage your existing asset story, but also your forward-looking one. So a little bit to Thierry's background and expertise. So different examples, right? So if you have a situation where you have a number of contracts that you're looking to fulfill and deliver on, we can leverage those contracts as part of the collateral, right? The other part of the underwriting can be, have you done this before? So either you as an individual, as a team, or have you delivered a project? So there's different ways that we can leverage the collateral. What makes us different also and unique is, remember I said that the solution is tailored. So you may need 100 million, but what you really need to start is maybe 12, right? So we'll tailor the solution where your first deployment will be 12. It won't be 100 million to start. The benefit there as an operator is that capital is not burning your balance sheet, right? Which again is what I enjoy with the model and why I leaned into it, is there's so many other vehicles where they deploy all the capital up front, but then instead of propelling your balance sheet, it burns it or burdens it. We never want to put you in that position. So that's how we would approach the situation.
And then are you taking equity or are you taking debt? What are you taking?
No, so again, as a private credit firm, it is primarily a debt instrument.
Okay, got it.
But if you're kind of familiar with those terms, which I am now, it very much acts as growth equity, but it's legally structured as a debt instrument. Where we're also a little bit different, because everything we do is either tailored, or the investment world loves to use the word bespoke. We can do a bit of a hybrid. So for example, if your cap table allows it, instead of being full debt, we can shave off what I say a few points in lieu of equity, but you always stay in control and there's never a majority stake.
And then how soon do you deploy? So let's say he has a business plan today, he gives it to you today, you give it to your underwriters tomorrow. How soon do you deploy capital?
So what's interesting with the Operating Expert Network is we've been able to develop a process where our diligence takes anywhere from 2 to 6 weeks. And if you've worked with other investors, it's usually, if you're lucky, 2 months, and usually more 6 to 7 months, which is the average industry standard. So it can be quite quick. In that situation, we obviously have to look at particularities, but we can be very quick. And that is also thanks to the Operating Expert Network, hence why Mightily and I do is so important. To not only the firm, but also to you as operators, because I think I heard Tara saying it, sometimes it's a question of you don't want to wait 7 months for the funding, because that just kills the opportunity. Time kills all deals and kills many opportunities. So that's where we can come in and be very quick. What's also interesting is relatively sector agnostic, so across different industries, but the operating expert network is what allows us to be relevant to you as a business, right? We can see cross-pattern knowledge and then intelligence that we can then bring back to you, right? So a few success stories. So one of them, which may be very pertinent for you specifically, is, first of all, it always starts with a team. So we're backing the owner-operator. So essentially non-sponsored, which is harder, but which is more meaningful. It's actually you who just said, which I love, it's what allowed me to find purpose behind the profitability, and that's what makes it meaningful, right? So the success story is, we had a gentleman called Chuck, who is an exited founder, really smart guy, really humble. He was in a completely different industry before, and then he saw an opportunity in the MSP space, so managed service providers. And in understanding that space, he said, wait a second, in envisioning how I could actually grow and build this business, I could do it the traditional way, the organic way, and build for the next 10 years, or I could accelerate that and grow through acquisitions. The other pattern he realized was that MSPs are very sticky. Once you're with an MSP, there's no real reason to leave. So what's interesting there is it makes it harder for you to grow organically because your cost per acquisition is really high and the time horizon there is much longer. But what that means on the flip side, on the M&A front, that's the perfect model. That actually helps us with the underwriting, right? So long story short, he put up a bit of capital to start, which illustrates skin in the game, which is important for us. That way we're both aligned on the same business objectives. In less than 2 years, we helped him grow from 0 to 40 million in EBITDA, which is very different than revenue. And he's completed over 14 acquisitions, and he's created optionality for himself, right? So right now he's continuing to grow, continuing to scale, and he can decide how and when he exits if he continues to grow, which he can. He obviously has a lot of interest from private equity, but he is the one that's staying in the decision helm there. So that's one example, acquisition-based. Another one which is really interesting, and I think I was sharing this with Kenneth, is we're also invested in whiskey. So interestingly enough, one of our operating experts, this is the other value they bring to us, is a few years ago, they came to us and said, based on what you guys do, I think you guys should invest in whiskey. Unfortunately for us at that time, we didn't fully understand the thesis he was trying to propose. We thought he wanted us to invest in a whiskey brand, but really what he wanted us to invest in is in the barrel. So we started to invest in essentially a company, and now a few companies, that buy, store, age, and sell barrels. What's interesting with that story is the barrel itself is actually a tremendous asset, which even if it sits there as it ages, it grows in value, right? So that's the underwriting story that we're able to develop there. And since then, we have actually, over time, become one of the largest financiers in that space. And this company owns now the majority of the supply across the world. So we allowed them to do that, and obviously we couldn't have done it without them, so that's where we come together. One of the highlights for me too is we've also invested in royalties, also brought to us from an operating expert, and we essentially helped a company that aggregates music royalties from film compositions. So what's interesting with that asset class is if you end up buying catalogs and royalties, they grow in value over time, and there's additional value creation that happens in aggregating that type of catalog, because it's multi-purpose. You can then distribute it across different means. We started off we helped that company acquire 4 catalogs for a little over 112 million. It wasn't upfront, but it was done progressively. Then we upsized it to another 89 million, so we deployed over 200 million in that company, and they've since exited for a very large sum, so that's another success story. So because we support so many industries, we've seen a lot of different red flags. I would say some of the red flags that we look for starts with the team. So it's really understanding our counterparty. That's actually sometimes what's most important, is who is the counterparty. Because unfortunately, and this is more from my operator background, it's oftentimes the counterparty that gets in their own way, right? As I'm sure you've seen in your space. So it really starts with the counterparty. Some of the red flags that we look for. So the caveat there is what's different with our firm is that we work towards a yes versus getting past no, but we do obviously look for yellow flags, red flags, green flags. So some of the red flags are inconsistencies in what the owner-operator is telling us, right? That is something that especially an investor or an experienced operator will pick up on very, very quickly. You have to be consistent. Your story has to be clear, your vision has to be clear, And I understand why investors have very little patience where your story is one version today, it's another tomorrow. The reason for that is if you're really growing and you're committed to a path, if you start going in too many directions, you're gonna set yourself up for failure. So that's a red flag that sometimes people don't realize is really holding them back. Obviously, what hurts is if you have a background, criminal background or others. There's different ways to obviously explain that, but that does unfortunately hold you back. The reason for that is all investment companies have an IC, right? And again, we need to understand who we are lending to and can we trust them, right? We don't ask for personal guarantees. In some cases, we will for bad acting, which I think is fair, because if we're going to take $20 million and buy Lamborghinis with it, you should be held accountable. But the background matters. A few other red flags is, ironically, is folks who think that they can achieve it all on their own. It's almost impossible to do. So you need to understand really what value you bring to the table, and then how are you building your team to actually scale forward. And don't pretend to be someone you're not. The investor will see right through that. And an example that we use there is, if you're the telco guy, then how are you also the real estate guy? You have to have a lane, right? There can be a thread behind it that you articulate, but you can't be all things all at once, because at the end of the day, you're really not providing as much value. And again, when you're looking at this type of sizable capital, we really want to make sure that you stay focused to achieve your largest potential, right? Building on something I said, pretending to have all the answers, actually the good investors will appreciate your honesty, will appreciate you saying, listen, this is what I have figured out, I haven't figured out the rest. Is that okay? Instead of trying to make up what you don't know, that will get you into trouble, right? So again, be clear on what you know, be clear on what you don't, and then surround yourself by others who do. And that's where you're able to bring forward a valuable proposition for yourself and then for the investors. So as a private credit firm, we have our own funds that we raise for and deploy. So right now, the firm is at Fund 8. We are going to raise our Fund 9 next year. But the credit vehicle is very different. We can actually recycle our funds. So typically RLPs provide us capital for up to 5 years, but the duration of our capital is 2 to 3, because we attach it to the growth plan so we can recycle the capital. So right now we have over $1 billion in investable capital because of how our funds recycle. And then we're at our levered Fund 8 that we're gonna raise. So we have different versions of the same fund too, onshore, offshore instruments. So we're raising that in March. We're choosing the right cornerstone LP, and that's where we get our funds. But what's different, also something to keep in mind, I think it was another question which is important, is sometimes when you're dealing with lenders or investors, you need to ask them, you need to do your own due diligence. If they do due diligence on you, you need to do due diligence on them. You should ask them Thierry's question. So what are your source of funds? What oftentimes you don't realize is it's individuals who are raising deal per deal. So there's good and bad things there, right? When you're raising deal per deal, it means they're coming to us and saying, hey, can you help me raise the capital for this deal? But if they don't have a relationship or the right relationship with those firms, they may not be able to deliver on their commitment. So one of the other success stories for Gaston is we had what we call a special situation, where his name was John, this owner-operator, had acquired 4 IT services company. It's called AppTrace, and he was about to acquire 2 more, and he thought he would get this done in September, but then he realized that the firm he chose was raising deal per deal, and they couldn't come up with a full $8 million, so his deal fell apart. Now that obviously holds him back because the person selling doesn't want to stay in selling mode forever, because if you're in selling mode, you're not in growth mode, so your value is progressively declining. So we came in, and within 2 weeks, we were able to fund his initial tranche to secure that acquisition. So that's kind of where we get our funds, and then why it's important to work with sometimes an institutional investor, because we really have our capital ready, right? We're not a bank, because we do a lot more than a bank. That being said, which is why I appreciate the ecosystem model, is the bank serves its purpose and has the right products for what it does, right? So think of private credit as anywhere between a bank and private equity. So we can provide much larger check sizes and we can scale with you, whereas a bank will typically cap at a certain point because they also look at your collateral very differently. So where a bank will tap out, we will typically come in. And like I said, it's anywhere from 10 to 50 million, which a bank will very rarely ever extend to you at a small, medium business stage, right? So that's one. The other part is when you're looking for flexibility and creativity in terms, to answer your question, private credit is the way to go. A bank, if you think about it, I used to sit on the board of a bank, it's all templatized products. So if you don't fit a form, if you don't fit a template, you get kicked out of the process, and then you have to go through its own very custom process, which can be quite rigorous. We don't have a template, right? We're tailoring it to what your business needs. So if you need 2 million to start, if you need to create liquidity, if you need capital allocated to pay back investors, if you need another 8 million for growth, that's how we'll tailor the solution. Like I said earlier though, keeping in mind that debt is always cheaper than equity. Again, for those who have done it before, they will immediately confirm that. For others who haven't, you may think it's cheaper. I can't tell you how many calls, JD, where I've been with CEOs. We're on that call, as we're walking through the model, they just realize that as they're wrapping up their round, they will no longer own their company. And they literally just realize it on that call. So their skin tone changes, the eyes change, and it's sad. Again, I was raised by entrepreneurs who bootstrapped it. You're the one putting in the blood, sweat, and tears. So as long as you understand the path you're taking, that's what's important for me, I feel, and that's what should be important for an operator. So that's what sets private credit apart. The other element that sets us apart too is there's this misconception that private credit is covenant heavy. I would say or argue it is, but have you ever looked at bank covenants at this scale? Very different covenants. They're essentially measuring you on things that sometimes make no sense or create a ton of headaches for you, because our covenants are really what you should be focused on, irrespective if you have an investment firm. What I mean by that, to give you an example, is we will have, let's say we helped fund an independent telco, which is obviously near and dear to my heart. Part of the covenants is churn. So if your churn starts going above a certain range, you are approaching a breach of covenants. But the reason for that is not because we want to be difficult, it's because if you as a business owner, if your churn starts getting out of control, you are not headed in the right direction. So that's the difference between our type of covenant, which in my mind should be part of your KPIs anyways, versus a bank will structure very different covenants. So yeah, so we are quote unquote much more expensive than a bank, but it's because we do so much more. When you run any model, you will see that if you're looking at a path where, let's say you're looking to go from 10 to 30 million, the path that gets you there in 1.5 to 2 years with private credit, the return you will get afterwards is tremendous, right? You're the one who's going to keep the majority of that, all of that return. So those are all the different factors you need to think about. Unlike banks who, to your point, here's your funding and then they walk away, or they essentially approve the product, we stick with you along the journey. So we want to make sure that you're going to succeed. So oftentimes, what experienced owners will realize is who you raise capital from is actually more important than how much capital you even raise.
True.
And
That's
with
true.
that said, what really made me lean into Met above other things is you also have to understand, is this private credit firm potentially a loan-to-own shop? Because they exist, and we're not. You have to essentially align your North Star, and our North Star needs to be aligned. So if part of my strategy would be, I'm gonna extend you a loan, but I'm okay in my portfolio to start owning your business, then you need to be at least aware of that, right? Because we may structure or do things differently in that case. And that's what private equity does oftentimes. And I don't like playing those games. So again, different paths for different people. We are not a loan-to-own shop. So sometimes there's a misconception that private credit are either loan sharks or loan-to-own. Absolutely not. We have actually no desire to own the asset. We want you to own the asset. We want to help create value. We want to help have you create enterprise value with your asset. That's really what's important. And again, to answer your question, that's where the operating experts come in. So as you grow and scale, oftentimes, and we have this happening right now, and Miley's helping us, we have a company that has outgrown their CFO. So the CFO that got them to 10 million is not the same CFO is going to get them to 30. We're helping them find that next CFO. We're not a search firm, but we will help bring in the talent, because you need financial capital, but you also need human capital. And that's where we come in. So think of attaching the growth capital to just your growth strategy or plan. And a growth plan is typically 1 to 3 years, right? Anything beyond that is a real business plan, but there's too many assumptions. None of us really know what's gonna happen in 3 years and more, right? So our duration is 1 to 3 years. So that's where it's helpful, because we can literally help accelerate your scaling in a very short period of time, which another saying is time is money, but time is money especially for you. The advantage there is we get to then get back that capital and redeploy it to help other owners and operators. So the time horizon is much shorter, but it's essentially much more focused, and it's focused on your growth plan. There can be other parts of the story, like I said, liquidity, refinancing, but the majority of the story has to be focused on growth. We are not there to purely refinance other credit lenders.
So basically, you're more of a relationship, not a transaction.
Yeah, so I say that all the time. Although we're both working towards a transaction, our approach is anything but transactional. And that's what's important for us. What I love from our managing partner is he understands we're really in the relationship business at the end of the day. And that's why the counterparty is so important. Because we are going to be on this journey for the next 2 years together. We're going to get through the twists and turns, because the ultimate outcome of that is making sure that you come out of it better and stronger. We're not looking for you to fail in any capacity, right? So that's also a huge differentiator, because if you think of a bank, they'll be fine seizing your assets, right? That's just the playbook they'll take, and that's okay. They have to do that. We don't want to ever have to do that. So we will figure out a way to not have to do that, bringing in the right team, creating a little bit more empathy, flexibility in your terms if you need to, giving you a little bit more runway. We will come in and help you get to that milestone as much as possible. As being a private credit firm and we deploy a debt instrument, it is mainly through the interest. We can do custom again where there can be a few penny warrants, there can be a bit of equity, but again, that's only if it makes sense for the cap table, it only makes sense for you. There's some owners who are like, I want you guys to own part of the business. So if you want to shave off a few points of interest for equity instead, they want us to actually look at that model. So we will provide different models, and then you get to choose, because you're always at the helm, which one you prefer. So that's where we make our return. Our returns are different though. Like for example, private equity is looking for anywhere from 3 to 7x. We look for 1.5, so very reasonable. What makes that reasonable and realistic for owners is that it's very hard to grow 3x in 2 years if you think about it. But it's reasonable to grow 2x, it's reasonable to grow 1.5x. So as long as we're both growing that way, we're happy. And venture capital is very different. They're betting on you growing 10x. So again, different paths and different strategies. So because we support so many industries, there's variations of assets across those industries. To keep it simple, what I would say is the right mix of hard and soft assets is usually the best approach, the easiest approach. So if there is a hard asset, I know a few of you are in real estate, that's why real estate is such a strong asset class. It's a hard asset, it's gone through blue, red regimes, it's gone through many cycles across the markets. So it's one that has essentially a huge track record, and it's a hard asset. So hard asset is usually the easiest one. That's why that's the preferred choice for like the Blackstones of this world and the larger funds, because it's just so simple. We like complex, we like different. So hard assets is one thing, but then there's soft assets. So anything that has to do with revenue as an asset, recurring, repeatable revenue can actually be sometimes as powerful as a hard asset. So that's where if you have a contract that is well set up and that is a secured revenue stream, we can collateralize that contract and help provide the capital you need to execute on that contract, right? So that, for example, is what we do with IT infrastructure. So that's another example. There's also interesting environments. So why we lend against royalties. So royalties is a great example because it has a lot of patterns and learnings. The reason why we loved lending against royalties is it's predictable in nature. A catalog has been there for X amount of time, so you can essentially look at different models to say how much can this catalog be worth at its peak, and what's the downside, right? What's the bare minimum it can actually be worth? And you can be somewhere in the middle, right? So an asset that has repeatability, predictability, and a track record is really one that is, I would say, the best for private credit, and that's why real estate is an example, but so many others. SaaS is another example, because with SaaS, there's a lot of recurring revenue involved, right? Spot revenue is not as valuable, right? So that's why if you're building a model, always look to understand, like, how are you building predictability in your model? Set aside the investor. Again, what I love about being the operator in the investment firm is it just makes so much sense for the CEO. If you have a business that you are relying on one-time projects, you're relying on reoccurring or spot revenue, it's very hard for you to grow. How can you actually fund your business yourself if you don't know what your baseline is going to be and what you're projecting towards? So always look to build in recurring predictability, either revenue streams or others, into your business model. So that's another example to kind of weave in. That's why too we see real estate development now incorporate post-development recurring revenue streams. that oftentimes helps tremendously the business case and helps your business case. But again, putting the investor aside, it's what's right for your business. You essentially want to always be the one that decides the path you're going to take, and the more you're setting up your business model for that success, the more you can then choose who you're going to work with versus having to accept terms that you may not feel are the right terms. Yeah, so that's why, again, think of royalties. Like the royalties is, let's say Michael Jackson has a catalog, right? That's not physical, but that can be an asset, right? Another example is the barrel is the asset in the whiskey theme. Another example is really interesting is in the insurance space. So we don't lend directly to insurance because that has a different risk profile, but we lend to the agencies behind the insurance companies. So there's a huge network of sales agencies essentially in the insurance space, and we lend against the commission advance. So the commission advance is the asset here. So it's obviously a soft asset, it's not hard. It's essentially a model where, because there's a time dependency, so as you know, insurance premiums, they renew year over year, right? But it's spot, but it's not because it's predictable. You know that there's going to be renewals every single year, right? And over a period of time, you can start predicting how is that revenue stream going to perform over time. So it's a different stage of repeatability, and we're essentially backing the commission advance that is being paid by the insurance companies to the agencies. So that's another example where we were creative in leveraging the asset. Another example is for telcos. The reason why telco businesses are so valuable is we have hard and soft assets. So the hard asset is the infrastructure. So the network itself has a value, especially now fiber is very valuable. There's a huge shift towards hybrid, both wireless and fiber. Again, has its own value, and then the other value is the recurring subscription, right? So when you look at public telcos, what's their biggest metric is subscriber growth, right? So that was actually the metric I was responsible for before leaving public telco, is your subscriber growth essentially is the leading indicator as to what the value is. If you're able to grow your subscriber base in a recurring, repeatable manner, you can demand a lot of capital because it's sticky, right? If let's say you're with your internet provider, you're not going to change every month. You may change every 18 months if you really want to, but there's both recurring revenue, there's an infrastructure that we can lend against. That's the perfect setup. We actually have what we call our 10 commandments. So one of the first ones is really the relationship. So we are there to work with you as partners, right? If you see us as vendors, then it's not the right relationship because we are not a vendor. We're not trying to be a bank. So we're really looking to build a relationship with you because again, we're going to get intimate, right? We're going to go deep into your financials. We're going to go through the twists and turns of your growth. So it starts and ends with a relationship. If we can't build the right relationship, we won't go forward. We had an incredible opportunity where a CEO was literally on the cusp of acquiring an asset from a much larger entity and was going to 10x his investment. We were at the last innings of a 4-week diligence, and he started disrespecting one of our team members, and we killed the deal. So if you're, excuse my language, an asshole now, then you're obviously going to be an asshole later, and that's what got in his way. It's not about the transaction, it's not about the return. That return would have actually been very, very large for us as well, but it starts and ends with the relationship. The other value is transparency. If shit's about to hit the fan, we want to know now versus later, because we can work together in figuring it out. Because again, we're not a loan-to-own shop. We're not trying to have you fail. On the contrary, we want to avoid you failing. So if you're starting to see a path where you're like, hey, it's not going as planned, things are getting delayed, my team is struggling to deliver this contract that I leverage as collateral, the sooner you tell us, the better. Because then we'll be able to figure it out together. We'll bring in operating experts, we'll bring in our ecosystem, we'll provide different ideas and solutions, and we'll get through that together. So that's another value that's really important for us.
Awesome, thank you.